Cap rate is an expected rate of return. It's similar to bond yield, if we have finance people on the call. So it's an inversion. It'd be kind of like similar like PE and stocks, but the higher the cap rate, think of that as more risk. So I'm taking more risk, so I expect a higher rate of return. So I think if you think about that way in your brain, you'll see. So like if I'm going to pay $1 million for a property, but it's in a troubled area, it's going to take a lot of work, that might be at a 10% cap rate, and I'm going to get $100,000 back a year in cash flow. But if it's a very stable asset, maybe that trades at a 5 cap rate, I'm only going to get $50,000 of cash flow because it's deemed less risk. So it's the same. It's kind of the inversion. I follow interest rates all the time. It's just a big part of my job. But as we're seeing interest rates move up now, we're expecting cap rates to move up as well. But cap rates are a lot more stubborn. So cap rates haven't gone up as much as interest costs yet. But as those cap rates go up, it's going to force property values down. And that's where a lot of real estate firms get in trouble is it's not that they can't make their debt service payment anymore. It's usually they can't refinance. So I can't qualify for a new loan that would, if I bought a property 3 years ago at a 5.5 cap and I had debt service at 4.5, but now, if nothing changed, now my debt service is 6% and it's still a 5.5 cap, then I get in trouble on a cash flow perspective. Like I've built a table that we use, and it just shows you, it's actually pretty interesting. The lower the cap rate you start with, the more impacted you get if you move up. So if you start at a 4.5 cap rate and move up 200 basis points, it has a lot more impact on you than if you start at an 8% cap rate and move up 200 basis points.